My dear friends, welcome to Rajshekar classes. This is lecture number 111. In this particular lecture, we will try to understand alpha versus beta stocks. Before going to this particular presentation, again let me go back to our tickertape.in, where just let me the screener. Let me go to the screener. In screener, what we were doing, just go to the stock universe, Nifty small cap 100, Nifty 500, Nifty mid cap 100. Just I'm selecting all. See, two show two more means let me select Nifty 50, Nifty 100 also. Yes, next if you want, you can choose sectors, as we were saying in previous lecture also. Now you can select whether large cap, mid cap, if you want closing price, PE ratio. Anyway, let me go to add filter. In filter, technical indicators. In technical indicators, I am choosing beta, and let me choose first what we have chosen, beta. Then let me choose alpha also. Let us try to understand this alpha and beta. Just see here, you are getting stocks with beta. The Reliance Industries beta value is 0.94, alpha value is minus 6.01, isn't it? Just what I will do here, just if I say some beta means let me check this one also. Now just see, transformers and rectifiers India, what is beta value? 1.28 and alpha value 124.48. Mazagon dock shipbuilders, what is beta value? 1.68 and alpha value 19.3. Means both beta and alpha we are arranging increase higher to lower values. Here also higher to lower values. I request all of you just go through alpha increasing, beta increasing, alpha decreasing, beta decreasing. There are four possibilities. Now just explore that four possibilities and check the company details so that you will get some sort of intuition. Let me go to this presentation. Anyway, just in ticker, there are various platforms to check this alpha values and beta values. Of course, just I am using star screener. Let us try to understand which is better, alpha versus beta, which is better for stock market analysis. We will try to understanding performance metrics in investment. Let us try to understand. There are different websites to understand this alpha and beta values. Moneycontrol.com, ticker tape, screener.in, TradingView. There are several websites. Actually, if you observe, high alpha, high beta, Tesla is an example for high alpha, high beta, means it will give high returns but volatile. In similar manner, low alpha, low beta, example this Procter and Gamble. In similar manner, negative alpha, high beta, positive alpha, low beta. This is ideal case. Which one is ideal case? Positive alpha, low beta means high alpha, low beta is ideal case, which outperforming with low risk. I request all of you just go to tickertape.in and try to identify companies for positive alpha, low beta. Even you can browse for other sort of companies also, and that will give some sort of intuition. Just if you try to recall what happened, we already discussed this one. Alpha greater than 0 means, just I am recalling, alpha greater than 0. What does it mean? It is stock beat the market less than. This is previous lectures. We already discussed all these things in our previous lectures. Market beta 1 means beta greater than 1. These things just I am recalling. Here important thing is we already discussed what is alpha, what is beta in previous lectures. Therefore, just I am skipping those slides for completeness of this study. Just I kept slides from previous lectures. Let us try to understand use cases. This is important. What is this use case? When is alpha is useful? That is important, isn't it? This use cases when alpha is important means, first one, evaluating fund manager or investment strategies. Alpha helps investors to assess whether a fund manager is adding value through skill, not just riding the market. Use case means if a mutual fund has an alpha of plus 2%, it means it outperformed its benchmark by 2% after adjusting for risk, a positive sign of manager skill. That's important. In similar manner, comparing active versus passive investment, it helps justify the higher fees of active management. If any actively managed ETF consistently generates positive alpha, it may be worth the higher cost over passive index fund. Back testing, that's important. Back testing and quantitative strategies. Why? Analysts use alpha to determine if a trading strategy can consistently outperform the market. Use cases: a back tested algorithm shows an annual alpha of 4%. It suggests potential outperformance if implemented live. That's a risk adjusted performance analysis. Why? Alpha accounts for risk taken to earn returns. Often use models like CAPM. I will discuss what is CAPM in future classes. Use case: two portfolios and 10% annually, but one has an alpha plus 3% while other is 0%. The first one is better risk adjusted performance. Those things I will discuss. Hedge fund performance attribution. Why many hedge funds focus on generating alpha regardless of the market direction. Use case: a market neutral hedge fund showing positive alpha indicate that it's making money through skill, not market movement. Portfolio optimization. Alpha estimates are used in optimization models to allocate capital to the best performing assets. Use case: a portfolio optimizer might favor assets with high expected alpha, helping maximum return for given level of risk. I can view this another use case: when is beta useful. Risk assessment help investors to understand how much market risk a stock carries. If you're risk averse, you had prefer low beta stocks that don't fluctuate widely with the market. Portfolio diversification. Beta helps balance risk by mixing high and low beta assets. If your portfolio has lot of high beta tech stocks, you might add some low beta utilities to stabilize it. Expect return via CAPM. Beta is core input in the capital asset pricing model to estimate expected return. Market sentiment analysis. Beta shows how stock market perform in bull or bear markets. Hedging and derivative strategies. Beta is used to calculate how much of a position to hedge using index or options and futures. But anyway, don't go to the futures and options. Benchmarking against indexes. Beta tells how closely a stock or fund tracks an index. That's important. Actually, I request all of you just go through this particular table, this what it matters. Alpha performance above market returns, beta means volatility index. Just I request all of you to go through this particular table. This particular table gives a lot of intuition, practical tips. Check alpha for mutual funds, ETFs to see past performance. Monitor beta to manage risk in your portfolio. Use platforms like I can say the platforms like Morningstar, Yahoo Finance or Bloomberg to track these metrics. I can say what is this alpha? It is skill based performance. Monitor beta to manage risk in your portfolio. Beta is risk based behavior. One is not universally better. Both are crucial depending on your financial goals. A balanced investor understands and uses both effectively. I request you to study alpha values and beta values for several companies by using tickertape.in. That is one of the best websites. Of course, there are other websites also which we discussed, but spend time so that it will give intuitions. Thank you so much.